Warren Buffett is considered by many to be one of the best, if not the best, value investor of all time. When people think of Warren Buffett, they imagine an old, bespectacled man going through stock filings and financial reports to find stocks that still offer great value, looking at things like price to earning and price to book ratios. A classic value investor. However, a closer look at Buffett's history reveals that calling him a value investor might be playing fast and loose with the term value investor. In fact, the secret to Warren Buffett's success doesn't actually lie in value investing. In this video, I'm going to talk about how Warren Buffett really made his millions and why this is important for you to know as an investor. By understanding what Warren Buffett did and didn't do to get to where he is today, we'll be much better able to manage our own expectations as private investors and also learn what we should do and shouldn't do when it comes to investing. In recent years, Buffett has been known to criticize hedge funds for the hefty fees that they charge their clients. Why not simply buy a low-cost ETF that tracks an index instead of paying these large fees to managers which often and statistically underperform the market? Well, while this might seem obvious today, it wasn't so obvious a few decades ago, and it was in fact exactly what Warren Buffett did and how he got his start in investing. In 1965, Warren Buffett created the Buffett Partnership, which was essentially a hedge fund. The Buffett Partnership actually charged 25% of all profits exceeding 6%. Now, this is actually a very hefty fee when we come to think about it. Just imagine if this fund had about 100 million in assets under management. That means that if it were to obtain a 10% return in a year, that would equate to $1 million in profits. 600,000 of this would go straight to investors, and there'd be 400,000 exceeding that 6%. Out of this 400,000, Warren Buffett would be able to pocket 25%, i.e. a fourth, which in this case would be up to $100,000. Now, this is actually how Warren Buffett began to really accumulate a great wealth. While Warren Buffett has always been known to find good deals, he has often done a lot more than simply value invest. An example of this is, for example, the investment he made in Dempster Mill back in 1961. Warren Buffett initially bought this stock because he felt that it was a great price. He bought the stock for $28 when the company had $50 of working capital and $75 of book value. At the very least, he figured the assets could be monetized and returns could be given to investors. However, this didn't actually happen. The company struggled and the stock price fell to appreciate over the coming years. Now, what Warren Buffett did was actually increase his position over the next few years in the company, eventually owning up to 70% of Dempster Mill. This actually equated to about 21% of Warren Buffett's portfolio. So, frustrated with the situation, and since Warren Buffett already owned most of the company, he actually instituted his own management at the top of the company. Eventually, he managed to turn things around and sold out of Dempster Mill at a profit. However, rather than call this value investing, this is perhaps one of the earliest examples of activist investing. As we can see, Warren Buffett didn't just invest in the company, but took an active role and even went as far as replacing the management. On the other hand, Warren Buffett has always been known to find great deals in times of distress. A great example of this is what he did with General Motors and Goldman Sachs back during the great financial crisis. During this time, these companies were incredibly underwater, and Warren Buffett extended them a lifeline. However, this didn't come at a cheap price. Arguably, he took advantage of his position and the fact that these companies were highly distressed to manage to strike very favorable deals for Berkshire. Investing in distressed companies or distressed debt is something that is often associated with more speculative hedge funds, and not exactly something well looked upon by the general public. Now, another example of this is what Warren Buffett managed to do in 2011 with Bank of America. Now, even though the company didn't need financial backing, Warren Buffett talked to the CEO, convincing him to take his money because doing so would provide stability and a stamp of approval for the company. Indeed, Bank of America ended up taking Warren Buffett's money. Berkshire injected $5 billion into Bank of America, not only receiving $5 billion of stock, but receiving $5 billion in preferred equity, which paid a 5% dividend, and also receiving options, which allowed him to buy 700 million shares of Bank of America at a price of $7.14 at any point during the next 10 years. In very favorable terms that Warren Buffett was only able to achieve by leveraging his size and reputation. So again, not something that necessarily any value investor can do today. Lastly, it's also worth noting that at many different times, Buffett has utilized derivatives or options in order to gain extra income. For example, back in 1993, when Warren Buffett wanted to buy stock of Coca-Cola, he actually did so by selling puts. Buffett was not happy with the current price of Coca-Cola, wanting to buy at a 10% discount. But instead of waiting for the stock to go down in price, he sold puts, meaning he could collect income while the stock reached his price target. Now, this isn't exactly a highly speculative form of investing, but again, it's not exactly value investing either. And it does require a certain level of sophistication as an investor and even a certain level of capital. So when all is said and done, it's pretty clear that Warren Buffett has done a lot more than just value investing. His initial wealth was achieved not by investing his money himself, but rather by leveraging his skill, which was being good at investing other people's money, and obtaining an income from this. Now, as a private investor, it's important for us to look at this story and understand that becoming rich through value investing is highly, highly unlikely. Your main source of income probably is not going to be your investment income, but rather the income that you generate through your job, or basically through a skill that you sell to the market. Now, of course, it's very important to take this income, save it appropriately, and invest it so that you can leverage it to the most. However, as I said before, Warren Buffett did not become a millionaire by value investing, and it's unlikely that you will too. Now, that's not to say that it's not incredibly important to know how to value stocks and how to invest your money, but we have to do so with the right expectations. On another note, I also want to talk about value investing itself. Now, when Warren Buffett started doing this back in the 50s and 60s, information was a lot more scarce, and finding value in stocks was perhaps somewhat easier, to the extent that it was not as easy for markets to perfectly value stocks. In today's age, most investors have access to a lot more information. This means that the markets are actually a lot better at pricing stocks today. To that extent, actually finding greatly undervalued plays might be a lot harder than it was back then. This is why I always say that stock picking and finding great value in stocks has to be complemented with a more overarching macro analysis. Especially in today's world where the actions of the Fed or geopolitics have such an effect on driving markets, it's really important to underpin all our research with fundamental macro analysis. So I hope you found this video interesting. If you did, go ahead and subscribe, and stay tuned if you want to learn more about investing.